It's time to learn about the Earned Income Credit, finally. This is a very popular credit. It is targeted towards the low income, low to moderate income individuals. It is often the threshold, it actually is the threshold that's used for the VITA tax program that you're about to learn about in another couple of weeks. But anyway, so the Earned Income Credit is targeted to people who work. So people who have an earned income. And the best way I can explain how this credit works is to draw a graph. So my math people, you're going to love this. Everyone else, maybe not so much, right? But that's okay. So I love the visual that a graph can add to the story that we're about to look at. Okay, so basically it works like this. The Earned Income Tax Credit, also known as EITC, but we'll often call it just EIC, Earned Income Credit, is a credit on your tax return. So it is a great thing, right? So we're going to put the Earned Income Credit on this side of the graph. So we're going to start with $0 at the bottom and then more dollars as we move up. So the higher your Earned Income Credit, the happier you are, right? Because yeah, you would like to get this refundable credit. So what that means is basically above and beyond what you owe for your taxes, you can get it refunded back to you. Okay, so then on this other side here, we'll start with $0 and again go up, and this will represent our earned income. And for simplicity purposes here, earned income is basically W-2 income. It can also be self-employed income, but it doesn't include stuff like your interest and your dividends. That's not earned income. So, okay, so here's how it works. Basically, $0 of earned income is $0 of earned income credit, right? So we're literally starting right there at the axis. And then we're moving on. So as you have more earned income, so as you have more, let's call it W-2 or self-employed income, you will then start to get the earned income credit. So how great is this, right? We're kind of going up. There will be a point where you plateau. I shouldn't say you, but where our tax tables and our calculations will plateau, which means it doesn't matter as I continue to earn income, I'm still only getting this exact amount of earned income credit. So we're going to see in a minute, the scenario is going to be the maximum is $560. So we're going to see that's our plateau. So people who earn income from, this area to this area, which we'll learn is like $7,000 to $9,000 for single, 0 children, they will only earn this earned income credit of $560. That's the maximum amount they can earn. And then as their earned income increases, it will then decrease their earned income credit to a point where after a certain amount of income, it will be 0. There will be no more earned income credit left. So it will be $0 of earned income credit. Okay, so we can calculate this manually by using there's a table below. So we'll calculate it. It's not super easy, but once you get it, right? And then we also can calculate it using tables. So there's 2 ways to calculate. We can either calculate it as we're going to do here, or we can use tables, the EIC tables. They're in your book. So I'm going to show you both. And I actually want to go to those tables right now because I want to show you how I can see that plateau. And I've already recorded this video, so unfortunately my writing is still in here. So let me go ahead and erase for a second. So if you look at this page, this is the earned income tables. Every year they reproduce these, change the numbers, adjust for inflation, right? So this page is actually like split in half just to save paper. So you can see the bottom of this page right here starts back up at the top of the next page. So, or the next side of this page. So that's basically what we're looking at here. This whole sheet of paper is two sides, 2 columns, let's say. Okay, so let me erase this next page. I'm sorry. Okay, so for our first one that we're going to look at, it is our first scenario is a single individual, or in our case, let's go back up to the top of this form. The way the earned income tax credit works is there's only two categories of filing status. So the first category, so filing status here, the first category is joint, so married joint. So if you're a married filing joint, you use this side. If you have 0 kids, there's your column you use, 1 kid, 2 kid, 3 kids. Then there's the other side of this, which says, hey, are you anything that's not joint? So basically all others. Then 0 kids, 1 kid, 2 kid, 3 or more, you use these columns. Okay, so that's how this tax credit works. And so my first thing I want to look at, we're going to look at single and 0. Okay, so that's going to be our focus right now. Let me erase some of this. So our filing status for our first one that we're going to look at is single and 0. So basically, as you have income, so you start to see income. This is your earned income. It comes from the worksheet, but basically it's your earned income. So again, for the most part, it's pretty much W-2 income. Okay, so there's your earned income. And as you start to earn income, you see your credit is going to increase. So I go from $2 and I slowly make my way up to $100. So as I'm making a little bit of money, I receive this earned income credit. By the way, there are rules for the earned income credit as well. So read up on those. But for example, a 15-year-old is not going to get the earned income credit. Okay, so $182. So you see, I'm kind of just inching my way up here, earning the earned income credit as I earn more income. So I'm in the 300s now. So you see, now at this point at the bottom of this page, I may have earned $4,750, and now my earned income credit is $365. So I'm watching this. I'm using this this table to kind of show that graph that I just drew out. So I drew that little hill, right? And then at some point that hill plateaued. So let's keep highlighting until we see that plateau. So I'm watching, I'm highlighting here. I see my credit is increasing. Do you see how it goes from $369 and it's increased now down to just a little bit over $500? Okay, so I'm still highlighting. And then suddenly I see, oh my goodness, the amount doesn't change. So suddenly I hit this point and I see that it's $560 and it continues to be $560. At this literal point in my table, this is where I've hit that point in the graph. So I drew that graph a minute ago and we saw that it plateaued and it comes back down. So I can see that this blue part that I'm highlighting right now, anywhere from about 7,300-ish to, we're going to see it's about 9,100-ish. I say ish, right? So give or take there. There's my plateau. There's the point where it doesn't matter if I make more money, I'm still only earning this much of my earned income credit. So I say earned, receiving. And then look what happens. After that point of 900 or 9,100-ish, it starts to go back down. So I can see suddenly I'm decreasing. My amounts are now going down. A minute ago, they were increasing, but now I'm going down. So now I can see that I must be on, at this point, I must be on what we call the phase out. So it's really simple to use this table and just come to this amount and say, okay, how much does this person get for their earned income credit? Well, they made $11,150, so their earned income credit is $406. Pretty simple, right? But we're going to use the calculation method where we'll calculate it more accurately. So right to the T, right to the penny, right? But regardless of the method we use, we still have this lovely hill with a plateau on top. So we know we increase and then we plateau and then it decreases back down.